Now, we've enjoyed our shares of K-dramas and taken over our neighbor's cuisine and made it our own. And nachos have now become as ubiquitous as bhujiyas in our country. But a little bit of competition amongst peers is not a bad thing. However, are we first amongst equals or one amongst equals? And to exactly understand that, we have the next session that is named India in the Context of Emerging Markets, Opportunities and Challenges Ahead. And it is my pleasure to invite Mr. Shamit Choksi, Director of CFA Society India and Head Offshore Fund Investments, ICICI Prudential AMC. Shamit joined the AMC in February 2016, and he oversees $3.5 billion of assets advised across various funds and institutional mandates of global clients. He leads manager selection for global strategies for local investors. He's been in India for over 17 years, being in Tokyo before that. Shamit?
Hi, everyone. Thanks for making it up to this wonderful conference. Quickly jumping into the next session, as we are obviously trying to run faster than time right now. But we have a very interesting speaker this time from Singapore. And the background here is that we always hear a lot about Indian asset managers talking about their outlooks and views. But somewhere we know that almost 25% of the market cap is owned by foreign investors. They think differently. From my understanding, they think very differently from domestic clients, the way they invest, the way they allocate. And we thought this session is all about India in the context of emerging markets. Today's speaker, Mr. Hiren Dasani, CFA, he's the co-head of emerging markets equity and the lead portfolio manager for Goldman Sachs Asset Management's India equity strategies. Prior to assuming his current role, he was also leading the Indian equity desk for Goldman Sachs in Mumbai, and his primary responsibility was to cover the financial sector. He obviously joined the firm in 2007 and as a director, and then became an MD in 2017. Before that, he was on the sell side doing research covering Indian banking and financial services sector at SSKI. He briefly spent some time at ICICI Prudential as an economy and credit analyst, and also in fixed income, and 3 years at UTI Bank in corporate credit. Earlier, he worked at Dove Kettle Chemicals, a specialist chemical company, given that he's also a chemical engineer from the University of Baroda. He's done his MBA from IIM Kozhikode in 2001, and he's also earned his CFA analyst designation in 2008. This is going to be a presentation followed by a moderated Q&A and audience questions. May I ask Hiren to please take it from here and enlighten us on emerging markets. Thank you.
Good morning, everyone. Thank you so much for your time today. And I'm trying something different today than what I usually do. I'm much more of a bottom-up stock picker. I like to invest in the markets picking stocks. But I thought when Shamit approached me for this, I thought let me take this as a challenge and draw upon the broader kind of expertise which Goldman can provide and provide you some insights with what we think is happening globally and where India stands in the context of the emerging markets. So here we go in. Okay, so first few slides on the global equity landscape and the 2024 outlook. Where are we now? So the first point I want to make is that from a broader macro perspective, 2024 is going to see some sort of a moderation in the macro as far as the global economic growth is concerned. So if you look at the US growth is likely to moderate. There is still some probability of recession, although the probability of recession has gone down quite a bit in the last few months. And the key message I want to leave you on this slide is that inflation expectations have gone down almost in every major economies in the last 6 months. So we are past its peak in terms of the inflation expectations, and there is much more likelihood of a soft landing at this point of time. Having said that, structurally we do believe that we are not going back in a very ultra low interest rate environment which we had for a period of few years, and that has its implications on the asset valuations going forward. The other point I want to make on this is that markets last year were much more dominated by 7 magnificent companies in the United States, and there is an expectation that markets are going to more broaden out, as we have already started to see in the last couple of months. So if you look at various parts of the world, if you look at growth expectations in the US, it's likely to slow down to about 2% next year. China is the most controversial part, where we'll spend some time later in the presentation. But at this point of time, even China, the expectation of growth is going to be moderate at about 4.8%. The interesting point is that the inflation expectations are well priced in by the market. So if you look at the US inflationary expectations, what is there in the price, the low inflation is very well expected by the market, so it's not a surprise anymore. Next chart we can look at is that the big phenomenon about artificial intelligence, and it's very interesting to see this, that in the history of US, the average productivity growth on a 10-year average basis is somewhere in the range of 2% or so. However, there are periods of huge productivity increases which are which are driven by some major technological innovations. We saw that in the 1930s when the electric vehicles were, when the motor vehicles were innovated. Then there was invention of the personal computer. Then obviously the internet driven the productivity growth. And the big question today, which all of us are grappling with, is that can AI be the next big driver of the productivity growth? The top chart over there shows that what AI could do to jobs in a variety of different industries. Our view today is that in most of the industries, AI could be productivity enhancer and is not going to take away jobs as much as what is being feared in some quarters of the market. So there will be some sectors where AI can take away the jobs, but for most other parts of the economy, AI can be enhancer of the productivity. And the co-pilot is the word which I keep hearing a lot nowadays in the context of AI. Moving on to the next, let's talk about the asset valuations. Now, if you look at the cross-asset valuations in terms of fixed income, equity, within fixed income, high-yield bonds or investment-grade bonds, it is interesting to see that the equity valuations are almost at the 90th percentile in the United States as compared to its own history. If you look at the S&P next 12-month earnings yield, it is at about 90th percentile. At the end of 22, it was at about 67th percentile. So markets have become more expensive. If you look at equities with respect to bonds, it looks like bonds are relatively more attractively priced at this point of time compared to equities. That's the key message on a cross-asset valuation. If you look at the equity valuations, and my apologies, it's a busy slide. You may not be able to see all the numbers from the screen. But the key point is that it's not that all the equity markets are equally expensive. The equity markets are much more expensive in the United States, but even in US, if you take out the big tech type of companies, then the equity market valuations do not look that expensive at about 17 times 1-year forward multiple. If you look at Asia ex Japan, then the market valuations look much more reasonable, broadly in line with the long-term average multiples. Moving on from the kind of broader outlook about the valuation, global markets and all, let's come a little bit closer to the home in Asia. How are we looking at next year? In Asia, if you look at the corporate earnings growth expectations for the 24 and 25, broadly the market is expecting about 17% corporate earnings growth for Asia ex-Japan in 24 and 14% corporate earnings growth in 25. Now, if you look at the, India, obviously, all of you know much better than I do, India is continuing to grow at about 15% or mid-teens, call it, kind of corporate earnings growth in 2024 and 25. But you are going to see big cyclical rebound in the corporate earnings in a market like Korea and Taiwan, where semiconductor cycle is now recovering. And we are clearly seeing inventory destocking happening in the semiconductors, both on the memory as well as on the logic side of it. And that is going to drive significantly higher earnings growth in Taiwan and Korea. China is one market where there is maximum debate in terms of the quantum of earnings growth. Consensus is looking at about 17 and 14. Goldman Sachs estimates are somewhere in the range of 11% for the next couple of years. So that's the kind of picture of the earnings growth which we are looking at over the next 2 years. If you look at the same idea from a sector perspective, obviously the more cyclical sectors are going to grow faster because of the cyclical recovery. But other sectors like healthcare and financials, etc., they will continue to grow at its own structural pace. How does the earnings downgrade cycle look as far as the Asia is concerned? So it's interesting to see that we are in about 21st or 22 month of the earnings downgrade cycle in Asia now. In the past several cycles, I mean, earnings downgrade cycles have gone longer than that. But if you look at the percentage of the downgrades which have happened in terms of earnings expectations, we are already down about 30% or so in terms of 12-month forward or 24-month forward earnings compared to where we started or where the analysts had started. The right chart shows you the year-on-year growth on the top right about the Asia. And the one big theme which markets have over the last 10 years is the underperformance of the emerging market compared to the developed market. And one question which keeps getting is about when does this underperformance reverse? You had a big period of outperformance of emerging market between 2000 and 2010. And since 2010, it has been all about US. You could very well stay out of emerging market and no asset allocator would have lost any money by remaining out of emerging market because US had such a dominant run over the last decade. The issue here is the earnings. The corporate earnings have not delivered, and any equity market over a long period of time is always going to respond to what is the earnings growth. Earnings growth is the majority driver of the returns for any equity market over a medium term to long term, and Asia earnings growth has just not delivered in the period of 2010 to 2020. And there are a variety of reasons for that, but the expectation is that on a forward-looking basis, if you look at over the next 8 to 10 years, the earnings growth is likely to be somewhat around 10 to 11%. If China and India were to perform as per the expectations. So that's the big kind of picture on the earnings growth where we are in Asia. And maybe moving on from there, if you look at the regional valuations where we are standing today, focus on the data which is there on the bottom left chart, bottom left table. 12-month forward price to earnings multiple about 12.5 times for Asia ex-Japan. And if you look at from a Z-score perspective, it is about 0.6 standard deviation below its last 10-year average. If you look at the variety of markets in Asia, obviously China stands out in terms of the valuation cheapness because whichever metric you look at, whether price to earnings, price to book, whichever metric you look at, China valuations have derated quite a bit. And on the other hand, India valuations stand out as expensive on whichever metric you look at. On a 12-month forward basis, India is now trading at about 1.4 standard deviation away from its long-term average. On a last 12-month price to book basis, India is now trading at about 2 standard deviation away from its long-term average. So whichever way you look at India valuations, they are expensive. Let's just take that. On the other hand, markets like obviously, Korea and Taiwan, there is not too much of valuation disparity compared to its kind of long-term average valuations. Moving on from there to, how are the flows and the equity ownership in various markets by the foreigners? It is interesting that if you look at the bottom right chart, foreign ownership of emerging markets, it's not only India that the foreign ownership has gone down. Over the last several years, barring Taiwan, almost every Asian emerging market has seen a decline in the foreign ownership, which is somewhat interesting because EM as an asset class has lost a lot of money over the last several years. And if you look at the foreign ownership or the FII or FPI ownership as a percentage of market cap, it's about 21-22% at this point of time, which is probably at a low of last 10 years or so. So the foreigners have not really benefited or participated a lot in the significant rally which India markets have seen over the last 12 months. Moving on from there in terms of China allocations, as you can see from mutual fund or hedge fund, the global allocations to China have significantly come off from its highs in the last 3-4 years for a variety of reasons, which we'll just get into a moment. So let's dive a little bit deeper into China and what are the thoughts on China. So China, I want to spend a little 30 seconds on the left chart. What is the long-term trajectory of growth in China? Current year, China is expected to grow at about 5% in 2023. 24, if you look at the expectations, are at about 4.5, 4.6%. And however, almost every long-term forecaster is expecting that China growth will slow down below 4% after 2026. At the size of the economy of China, even 4% is a very respectable growth, but the pace is very clear, the direction is very clear that you are going to see slowdown in the China economic growth as we go forward. There are a whole lot of statistics on the right table. I'll not go in detail on all of them, but the point to be made is that exports, which was one big driver of growth in China, is no longer a big driver of growth. And China is going through deflationary environment. Nominal GDP in China growth is lower than the real GDP growth, which is a very tough environment for the corporate earnings to be in. And it is expected that sometime in the second half of 2024, China will move out of its deflationary regime, which is what it is going through at this point of time. So if you think about China, the growth model of China historically was driven by 3 big drivers. The first driver was the exports. China is and was the factory of the world. The second big driver was the real estate investments. And the third big driver was the infrastructure investments by the public sector, whether it is central government or the state government and the local governments of China. We think that China will need to look for the new growth drivers as it goes forward, because all the 3 growth drivers are probably peaked out. And for a variety of reasons, if you look at the exports share of the goods of China in the global trade, it has peaked out at about 18% few years ago. Real estate, we all know what the situation is. And because of the very high level of debt at the local government entity level, you are seeing much higher debt to GDP at the country level, and that as a result, China cannot stimulate the economy the way it did after 2008 financial crisis, where it was massive infrastructure boost, and that led significant growth, but that has led to unproductive investments, that has led to much higher debt to GDP for China. So let's look at real estate. I mean, real estate, if you look at the left chart, real estate was a significant contribution to China's growth till about 2020 or so. And since 21, 22, 23, China is now contracting in terms of the real estate sector. And real estate is a negative drag. It is expected that real estate will continue to be a drag for at least next 3-4 years till the market kind of finds its equilibrium. And the rough numbers which I keep hearing from the economists or the real estate experts is that China needs about 8 to 9 million units of new residential unit constructions, whereas China used to build in excess of 15 million units till about 3 years ago. So there is substantial amount of excess built which has happened, which it needs to digest. On the other hand, if you look at the right chart, it's about the debt to GDP, which we just spoke about a second ago. And the total debt to GDP has gone up quite a bit to about almost 280 to 90% to GDP. And bulk of the debt in China is not for the corporate sector, or it's not with the household sector. It is more about the local government debt, which is now the cause of worry. And that's why the infrastructure investment cannot be the big driver of growth for China going forward. China is obviously cognizant of this, and if you look at a couple of other issues in China is obviously the US-China relationship, which all of us are aware that today it's not in the best possible place, and US is now seeing China as a strategic competitor. US is quite clear that it would want to restrict China's access to advanced semiconductors. And if those restrictions can be, also the drag on the growth of China. Obviously, population has peaked out in China, so the demographic dividend which India is seeing now, China did see that few years ago, but now China is at that phase where demographics are not helping to drive the economic growth. If you look at the policy uncertainty index, this is something, obviously, in the hands of China's own policymakers and its own government. We have seen since 2020 substantial increase in the economic policy uncertainty in China. And this effectively started with the cancellation of Ant Financial IPO towards the end of 2020. In the 2021, they completely made the private education sector not for profit focused. There was a big tuitions and the after school tutoring sector, which was a huge market cap at that point of time, and they overnight kind of made it not for profit because of the social considerations. After that, there was a big crackdown on the internet sector in terms of the data security, in terms of how much data you need to share with the other platforms, gig workers, wages and all. So there were variety of changes which were made in the economic policy for the internet sector. Now, to be fair, many of you are parents of teenage children here would probably not mind, your child spending less time on the TikTok and the gaming through the day, but you don't want the government to dictate that. You want that to be happening more on an organic basis rather than the president of China telling you that you need to do this. So that is where the key difference is. You will see that if the internet companies keep becoming larger and larger globally, there is very likelihood that in the developed markets of the US and Europe also, many of the internet companies are going to see increasing regulations. But the way these regulations are framed in China are very different. The way these regulations are implemented in China are very different compared to a democratic society, which has a lot of back and forth in terms of policy making. So that's about the economic uncertainty. Now, if you look at the sensitivities of various Asian economies to China's growth, it is quite clear that the economic sensitivity is highest for countries like Taiwan, Thailand, because Thailand depends a lot on Chinese tourism, Korea, because a lot of Korean companies have deep linkages with China. But if you look at the economic, sensitivity to China growth, India has one of the least economic sensitivity to China growth, because India's growth is much more domestic oriented. India's growth is much more driven by the domestic consumption and services. So that's what makes India somewhat less correlated in a world where China is kind of slowing. If you look at what's happening to China's trade, it's important to see that China is trying to move up the value chain, and China has done a lot in terms of moving away from the low value-added, very commodity type of exports to higher value-added, more technology-intensive exports over a period of time. And those sectors are now more than 50% of China's total exports. One has also seen that the share of China's exports going to the developed market has gone down, and China's exports to the emerging markets and the Belt and Road countries have gone up quite a bit over the last few years. So China is also, diversifying a lot in terms of where it is exporting and what it is exporting. The other point I want to make about exposure to China final demand, I think we can skip that. Moving on from there, in terms of infrastructure investment, again, historically it was much more driven by the traditional infra, but in the last 3 years, the infrastructure investment in China is much more driven by the new infra, which is green infra, solar, wind, renewable energy, electric vehicles. Those are the kind of sectors which are seeing big increase in the infrastructure investment in China over the last few years. What does it all mean for the earnings and valuations and flows for China? So if you think about the earnings expectation, which we looked at earlier also, the consensus is at about 16-17% earnings growth. We think that numbers will probably come down a little bit, but it is still likely to grow at double digit in terms of corporate earnings for the next 2 years. And within that, it's not going to be so much driven by the profitability. So if you look at the net margin of MSCI China, it is at about 10% or so. It's not very different from its long-term average net margins. Yes, net profitability of Chinese companies was much higher between 2010 to 2020 period. But if you believe that this is the new reality of more regulations, this is the new reality of the slower growth, then the expectations of a significant profitability improvement should be muted going forward for China. How about valuations? And this is very interesting. If you look at the left chart, whichever way you look at China valuations, they are quite cheap. That's the simple point. If you look at the MSCI China, it's trading at 8.7 times 1 year forward, which is about 1.3 standard deviation below its long-term average. If you look at the banks, Chinese banks, they are trading at about 3.5 times price to book. MSCI China, median market cap based, if you look at it, that is trading at about 1.7 times standard deviation below its long-term average. And how about relative valuation compared to the rest of the world? So the point, if you look at MSCI China versus EM ex China, because EM index valuations are influenced by China, which is the largest component. But let's look at EM ex China versus China. There also the valuations are at about 30% discount compared to its long-term average. And compared to developed market, obviously it is significantly more cheaper at about 40% discount and close to 2 standard deviation below average. Allocations, we spoke about it. On the right-hand side, there is a chart about what would happen if the US were to completely disengage from China. And in a very extreme scenario where all the US corporate pensions or the US public pensions board tell them not to invest in China, that can lead to about $440 billion of outflow from the Chinese equities. This is not the base case outcome, but this is an extreme case where all the US pensions are told not to invest in Chinese markets at all. and that can lead to almost 40% of the current foreign holdings going away from China. So it's something worth to be aware of. I don't think it's a base case scenario, but that's a risk which markets are also worried about. So that's about that. But having said that, it's not all gloom and doom in China. Obviously, long-term story about China, even at about 4% earnings growth, 4% economic growth, it will still be, one of the largest consumption growing economies. If you look at, the millennials, in China, they will still be one of the largest population of millennials in China. There are industries where it is gaining very dominant market share. So let's say industrial robotics is one area where China is already more than 25% of the global production. If you look at the electric vehicles, and my apologies, this chart is slightly dated, but at the end of 2023, China has already seen about 35% penetration or close to 40% penetration on a run rate basis on electric vehicles. And this is the country which is very quickly moving away from the ICE engines. Probably the only country in the world where electric vehicles are actually cheaper than the ICE vehicles today in China. And even without meaningful subsidy of the government, because of the production scale, the electric vehicles are much more affordable today. BYD, as probably you guys are aware, is become larger than Tesla now in terms of how many electric vehicles they are selling. Solar and wind, China controls almost 70+% of the global capacities. So if the world has to decarbonize, they cannot completely, move away from China-driven supply chain. Although obviously there are efforts by the US and Europe to localize the supply chains in the solar and wind as well. So it is going to, focus on new drivers of growth. We believe consumption, services, and more advanced kind of technology-driven exports would be the drivers of growth for China. But directionally, it is likely to slow down. That is the kind of big message. Moving on from China to maybe few minutes on India. Obviously, you guys are all much more familiar about India. I'm not going to spend a lot of time on it, but 6.4, 6.5% kind of real GDP growth, inflation cooling off or stabilizing at about 5%, and current account deficit also getting better at about 1.3%. About 1.3% last year and 1.9% next year. So we are seeing a very stable macroeconomic environment for India. Growth continues to be robust. Inflation and the broader macro stability is one of the best achievements by the central bank in the last few years. And that macro stability has many more implications in terms of consumer confidence, in terms of the confidence by the corporates and for investing and so on and so forth. I think we all tend to underestimate how much macro stability plays its role in driving the long-term capital allocation decisions. But it's quite staggering that in one of the fastest, pace increase US interest rate environment in the history, the volatility of Indian currency over the last 2 years is one of the lowest. Whether you look at INR volatility compared to the emerging market currencies, or whether you look at INR volatility compared to the developed market currencies, it is one of the least volatile currency in the last 2 years. And that macro stability is something to be cherished upon. I mean, we probably Dr. Subbarao also talked about it a little bit, but the big theme is that capacity utilization is now reaching to a limit where private capex is likely to pick up. So far, it has been driven more by the public sector capex over the last several years, but there are all the signs of the private capex picking up and likely to drive the growth in the next few years. And from there, if you look at the left chart, this is quite interesting that cumulatively over the last 5 years, as a percentage of GDP, government has done a huge amount of spending or huge increase in the spending on the capex, on the public infrastructure. I think cumulatively 20% plus CAGR over the last 5 years on the infra spending, and that infra spending is going to lead to lower logistics cost. And from there, I just want to spend a minute on manufacturing. I mean, the big expectation is about manufacturing revival and India becoming more competitive on manufacturing. If you look at the very basics of it, there are three big costs which any manufacturing company would have, which is labor, energy, and logistics, right? I mean, effectively, it all boils down to these three big cost drivers. And from a labor perspective, India was always cheap in terms of the labor cost. So if you look at the top left chart, India's low minimum wage at about $67 is much lower even compared to the countries like Vietnam or Philippines and other Asian countries. But the interesting part is about the productivity. Historically, it was always believed that Indian labor is not very productive. So on a productivity adjusted cost, Indian labor is not that cheap. But it is interesting to see that now with productivity increases, on a adjusted basis also Indian labor is actually cheaper than China in many contexts. And on the energy side, we are seeing that the energy cost which the average industrial units are facing is also very similar to the energy cost in China now. And logistics, as we spoke about, is going to drive the spending on the infrastructure, is going to drive the lower cost on the logistics as we go forward. So there are all the push factors from the country to make manufacturing more competitive, and that is going to help. And if you see the bottom right chart, there is a huge difference in the productivity per person in a manufacturing and the services sector. Now, almost every country in the world, when it went through the industrialization phase, the starting point was that 80% or more population was deployed in the agricultural labor, but over a 40, 50, 60, sometimes even more than 100-year period of time, those share of the labor deployed in the agriculture has gone down less than 10% in any other country, and India is no exception to that. It's just that India has started that journey only about 25, 30 years ago and much more accelerating now. So I think there are all the signs that manufacturing is becoming more competitive in India. And this is also happening in the world, where the world is looking to diversify its supply chains in a China plus one supply chain diversification strategy. So there are both push factor as well as the pull factor for the manufacturing driven growth. Corporate tax rate and the inflation, obviously, after the corporate tax rate cut, 22% corporate tax rate, and for the new manufacturing companies, 15% corporate tax rate. This is also making corporates more incentivized to put up capital in India, and the stable inflation at about 5%, obviously we spoke about, but that is also a big driver for the confidence in putting up the capacities. Finally, we can probably talk a minute about the valuations and the growth. So earnings growth expectations about 14-15%. We talked about that earlier, so let me skip that. This is also interesting that unlike many other Asian markets, the valuation, I mean the earnings expectations have not got cut in the last couple of years in India. Historically, my favorite pushback to sell side was that every year you guys start with 15% growth and every year you end with 0% growth. I mean, that used to be the norm of Indian sell side expectations every year for the last maybe several years, but in the last 2 to 3 years, the earnings expectations have held up and actually gone higher as the earnings have positively surprised. Profit to GDP, I mean, we are not there at peak for the corporate profitability, so there is some room to improve, but we are reaching closer to the point where incremental earnings growth will have to come more from the nominal revenue growth rather than the profitability improvement. And finally, valuations, obviously we spoke about it earlier, but just putting out there at about 22 times 1 year forward, market is expensive at about 1.4 plus standard deviation from its long-term average. And compared to the region, the peak premium was about 90% at the end of 22. At the end of November 22, actually, when the China started to rally after the zero COVID policy restrictions were lifted. And then sometime around March, April last year, that premium went down to about 50% compared to the region. And now we are back to about 75% premium in terms of the valuation to the region. So that's broadly that. We talked about the foreign ownership and the allocations of global funds to the emerging markets, to the global or emerging market funds to India. It is interesting that if you look at the on the right chart, the GEM funds, they have not taken a big overweight call on India. So it's not that everybody is overweight on India meaningfully and market. I mean, they've all loaded up on India. It has some scope of increasing the allocations if the market continues to remain buoyant. Maybe let me pause there and maybe we can go into the questions from here on. Hope that was helpful.
Thanks, Hiren. That was quite a presentation. I think it's a good warm-up, not only for this session, but for the entire day as well, as people really wanted a view on what's happening around the world, and especially in some large markets like China as well. I'll jump straight into the question for India first, because the slides are quite fresh. Small and mid-cap flows have continued unabated in the markets. Domestic investors have been piling up SIPs, almost $2 billion in December. That's quite a lot of money. The question is, do you feel worried with this phenomena? And where do you think are we headed in terms of a possible bubble scenario in a market like India? And we'd like to understand, what is your definition of a bubble scenario? How would you identify those risks or red flags? And is there something that the audience here can understand as they look at 2024 from such lifetime highs?
Sure. Again, I would start with a disclaimer that market timing is the most difficult thing to do, and in my professional career, I would never want to kind of manage money by timing the market, because that's something which I don't think, at least I have the capabilities of doing that. There are telltale signs of exuberance in some pockets of the market. Obviously, jokingly, I tell that the bubble is when your auto driver or your taxi driver starts to giving you the small cap and mid cap tips. I don't think we have reached there yet. There are obviously signs of exuberance in some parts of the market, but moving away from lighter remarks. I mean, if you look at the mid and small cap rally in the last year, or even for the last 3 years, the earnings growth of mid and small cap have also meaningfully outpaced the earnings growth of the larger cap companies. And as I said earlier, eventually it's all about the earnings growth. So if you look at the valuations of mid small cap as a cohort, they do look a little bit more expensive compared to the long-term average premium or discount compared to the large cap. But mid and small cap is going to be much more about stock selection, stock picking. So you can still find quite a few. You can still find quite a few individual names which are attractive, but one has to be more thoughtful about. One has to be more thoughtful about the stock picking at this point of time. And I think the other way to think about mid and small cap is that who is the usual buyer of the mid and small cap stocks, right? The domestic mutual funds are obviously the most likely buyers of the mid and small cap stocks. The PMS and the AIF kind of vehicles which have become quite popular in the last 5 years. Those are the natural buyers of the mid and small cap stocks. If you are running a global fund where India is a very small part of your allocation, you are not naturally going to be buying mid and small cap stocks. Your holdings are going to be more large cap oriented. So market has seen much stronger flows from the domestic mutual funds and PMS, AIF type of segment. So that is also helping the mid and small cap valuations. I don't think we are in a bubble territory, but yes, valuations have risen higher to its long-term average, and one needs to be thoughtful in terms of stock selection.
That's interesting because obviously that's the buzz in the audience today is that we're here for the markets from here on. But taking a step back on some of the slides you mentioned about government spending and in terms of how Indian economy has evolved over the years. Of course, we'll come to China at some point, but the most of the economic growth that we understand has been fueled by significant government spending, and we are aware this government has been making a lot of efforts on the policy front as well. But somewhere there is a critique going in the market that private investment has not picked up despite all the high decibel noise that we hear about new projects, great tax rates at 15% for new greenfield projects. We hear a lot of announcements, but private investment from a print perspective is not showing up. How do you assess this difference between public and private investment? We are in a year of elections. We anticipate next year could be different from a government perspective in terms of their policy efforts. And how will this impact financial markets going forward?
Sure. So, I mean, if you take a step back, the reason why private investments slowed down quite a bit was the private sector was in a deleveraging mode. Between 2009 to 2013, there was a lot of excess leverage built up on the private sector, and from 2015 onwards, the private sector has been on the deleveraging mode. It is also worth noting that after the passage of IBC, the insolvency code, the risk-taking ability in terms of drawing excessive loans and the leverage on the balance sheet and not putting enough equity on the capex has gone down by the Indian corporate sector, and which is the healthy thing to do, because there is always the fear of losing your business if you take too much of debt and things don't play out. That fear was not there earlier. Having said that, I think government realized that they had to kickstart the capex cycle, and that's why they did a great job of increasing the 20% CAGR in the capex spending over a 5-year period. Now we have reached to a point where we are seeing increasing signs of the private capex picking up. If you look at the data points like the new project approvals by the private sector, if you look at the data point like how much bank lending approvals have gone to the private capex, all those data points are showing the signs of the private capex pickup. If you look at the 2003 to 2008 period of the big private capex boom in India, that private capex was much more driven by two big capital intensive sector. One was thermal power and the other was the metal and the commodity related sector. This time the private capex composition is going to be very different. It is going to be far more diversified. It is going to be driven by many more number of companies. So the average ticket size of each project may not run into $1 billion, but it is going to be more driven by manufacturing. MNCs will probably play a bigger role in the private capex in this cycle compared to the last cycle. So the composition is going to be different, but we are seeing some initial signs of the private capex picking up.
That's interesting. So I think you're anticipating that the macro conditions are now better, so the credit growth on the private side will be much higher. Capacity utilization has improved, but do you believe that Indian businesses typically don't increase new capacities unless they cross 80-85% on utilization, and possibly they're still below that number as well. So would you think that macro conditions are good, but do you think businesses are incentivized to add capacities for the future?
Yeah, I mean, the capex decisions are always driven by the confidence in the medium-term outlook of the economic growth, and with political certainty, continuity in the policy. If you don't have the enough confidence now, then when are you going to get the enough confidence, right? This is as good as it gets.
Okay. We will come back to Indian markets. I think there's a lot of interest, I think, on the audience Q&A as well on global markets. But I had a question prepared earlier on emerging markets. And you mentioned the slide that global investors are typically staying away from a lot of these small mid-cap ideas in the markets as well. But we also see that global funds are quite underweight India allocations, while emerging market funds are a bit overweight because many other emerging markets haven't done well as per your slides. How would you allocate within emerging markets, and how is your India allocation decided since you manage these emerging market funds? What's the risk budget around this, and what's the guardrails that you put in place? Because I know our index is quite tech energy heavy on the large cap side, but still in the audience and all of us anticipated much more foreign investor flows alongside domestic.
Sure. So, I mean, every investor has its own style. Our investing style is very bottom-up, stock picking driven. So we would not generally take a big call on country from a top-down perspective. We are very happy to be overweight or underweight on a given country within a range of, let's say, 5 to 7% compared to the benchmark. As long as, because once you start going out of that range, then you start inadvertently take country calls. So we don't want to do that. But typically, India has always been an overweight, allocation for us because, we have a great team here, and because we also have a India dedicated fund, it provides you much more bottom-up idea generation, even for the emerging market allocations as well. So from our perspective, we do find great bottom-up opportunities in India. We have been overweight on India. We continue to be overweight on India at this point of time. But it's not that we are taking a big country call. Our overweights on India as a country always remains within, let's say, 2 to 5% of the benchmark weight, because that's not our mandate to take a big country call. If you look at the slide for the broader allocations, the maximum EM overweight to India was about 500 basis points for the broader market, and that was at about 2014-2015 pace, 2014-2015 time frame. Currently, the average overweight on India for the average EM manager is at about 100 basis points or so. So there is definitely scope for that to go up. I think the biggest thing which people are trying to grapple is the valuations. And when the rest of the world looks so cheap, if you have the ability to move around capital, you got to be thoughtful about how much you want to worry about the valuation. Obviously, nobody is questioning the attractiveness of the economic fundamentals. Nobody is questioning about, even when we talk to the clients who are the global asset allocators, there is a very clear view that this is going to be one of the fastest growing economies for a long period of time. There is clear view that political stability and economic policy certainty is going to be there. So all those things are very well agreed upon. But valuations is one question where you get the most pushback from the asset allocators.
Sure. I think we also are aware that if other markets don't do well, there's a limit how much you can add India in an emerging market portfolio. So at some point you're also dependent on other markets to make up, or you have to sell India because of excessive overweights in your portfolio.
Yeah, I mean, one thing which we have seen last year, and this is not only for us, but at the broader industry level, if you look at the India dedicated foreign funds, they were not getting any inflows till, I would say, 2023. And sometime from the middle of 2023, most of the India dedicated funds have started to get, better inflows. I mean, if you think from a global asset allocator perspective, if you're a global pension fund or a corporate pension fund, historically India's weight was much smaller in the benchmark. So it was almost like you could ignore taking a separate country allocation call. But now with about 16-17% weight in the emerging market, and about more than 3% weight in the all-country world benchmark, you are looking at a decent weight which makes standalone India allocation more attractive for the global asset allocator. So that's one trend which we are seeing increasingly in the last few years.
Sure. I think moving away a bit from Indian markets towards China, you mentioned a lot about how the China markets the financial markets have not performed, but from an economic standpoint, they're taking some great steps in terms of moving towards managing the transition risk and managing new infra as well. How would you compare the new model for China versus what we are trying to implement in manufacturing in India? I know Dr. Subbarao spoke about the difference between where the value add lies. Now, what's your definition of what we should be doing? Should we be addressing labor productivity, or should we be addressing benefits out of cost of capital and land reforms? Because there's a huge labor force out here which can be deployed, but I don't see any meaningful adoption of labor in many of these new investments.
So the way I think is that at the level of economic development where India is today, and Dr. Subbarao started with that we are a large economy, but we are still a poor country at about $2,500, $2,700 per capita income. We need all drivers of growth. We need all levers of growth, whether it is manufacturing, services, capex, private, public. We need all of them. So that's the starting point. Obviously, labor deployment is going to be critical because you are not going to be able to provide value-added jobs to the 10 to 12 million new workforce addition which we are seeing purely on the services basis. And I think the big theme here is that you want to move away labor from the low productive agricultural activity to higher productive manufacturing and services activity. And services alone cannot take up that, so you need to have manufacturing as the additional driver of the job creation, and which is where I think India is focusing on. So if you look at the PLI schemes, many of the PLI schemes are focused quite a bit on the labor intensive sectors. Textile is one, auto component is the other one. Within the semiconductor also, the labor intensive parts of the value chain of semiconductors, which is more like electronic manufacturing services, EMS, or OSAT type of, OSAT type of, activities in the semiconductor value chain. Those are more labor intensive. That's where India has the natural competitive advantage. I mean, we can talk about the foundry investments and all, but I mean, those would be good to have. But from a broader economic perspective, I think the labor intensive industries, if India cracks it, then it would be a huge beneficiary.
Sure. I have three quick questions, I think, given the time that we have left. One is obviously other Asian markets. You've been covering Indonesia, Vietnam, a part of Asia as well. Are there other market opportunities out there? Do you see that we can't look at India's development in isolation? So what are the other capital market expectations in Asia, and how would you advise us in terms of the outlook for 24 in some of those markets like Japan or Indonesia and Vietnam?
Yeah, I frankly don't cover Japan myself, but I've seen that Japan is seeing a huge interest, mainly because of the corporate governance reform, which Japan as a market is seeing now. And there is a sign that we are coming out of a very long period of low inflation or a deflationary environment in Japan. So that is one market which is seeing a lot of interest. I personally don't cover that. Outside of Japan, obviously in the emerging Asia part of it, Korea and Taiwan are very semiconductor driven, so they are very global driven markets. They are cyclical markets, but within that there are obviously some great businesses to look at. And we are seeing that the semiconductor cycle is recovering. Destocking of the inventories is largely over. So there is optimism about semiconductor and the component value chain kind of doing better over the next 12 to 24 months. And yeah, I mean, China will see where it goes. But the valuations are certainly quite cheap, and it is up to the Chinese policymakers to give more confidence to the the market to kind of, allocate more capital there.
Sure. A very quick question, I'm expecting more of an objective response here is, you manage a pretty large fund for India, almost $3 billion India equity fund, and you have almost 80 stocks as per the last published number. What kind of a market is India for you from a portfolio construction standpoint? Do you want to add more names or do you advise, some of the PMS managers here are more concentrated, they go out and talk about the best ideas on the street. Mutual funds tend to be more liquidity focused and more diversified, but how are you sort of constructing portfolios for global investors? Why 80 stocks in a single country portfolio?
Yeah, so I think it depends on the mandate which you have, right? And ours is more of a daily liquidity type of mandate, so very similar to the mutual fund structures which we have in India. And in that mandate, if you want to manage, so our starting point is that we find historically more opportunities in the mid and small cap segments, which are more alpha rich segment. And we never take a view that mid and small caps are undervalued, that's why we want to be in the mid and small cap. But we always take a view that on a bottom up basis, you can find great opportunities, which if you can hold it through the cycle, then mid and small caps are a great place to be. From an active stock picking point of view, you need to have the right team for doing that. You need to have the right investment process for doing that. But over the years, mid and small caps have been a great alpha source for many portfolio managers. Now, if you want to own more mid and small cap compared to the benchmark, but if you want to do it in a risk-adjusted manner, trying to control the liquidity of the portfolio, and if you also want to manage large sums of money, then there is no other way you can do it by other than by owning more number of stocks. And you need to have the right team, the right investment structure to do that. So I'm not going to comment on whether concentrated is good or diversified is good. I think it depends a lot on your mandate, it depends a lot on your investment process and the team structure.
Then the last question is just pick one of the two. Are markets optimistic or exuberant?
Optimistic.
What can surprise positively? Fixed income or equities for 2024?
I'm an equity investor, so I would hope to be equity.
Between EMs and India?
I'm not a sell side, so I'll duck that.
Okay. Hiren, thanks very much. It's time's up, but thanks for joining us here.
Thanks, Hiren. Thanks, Shamit, for an insightful session. I would like to call Bihari Lal Devra from Abacus to give a vote of appreciation. BD for us, who became CFA charter holders 8, 10, 12 years ago, BD was the face of CFA society back then. So for us, BD was the CFA society. Thanks a lot for all of you.